with this situation that we've got with the US election, how we've seen markets react to a Trump victory is that it will be positive for the US dollar. And we do agree that that would be the case in the short term, but over the longer term, there's a clear historical bias towards the dollar actually appreciating during a Democrat presidential cycle compared to a Republican. So it's not just a clear-cut answer of the US dollar is going to strengthen under Trump and weaken under Harris, but you've got to look at the longer-term implications based on the policies that are being put forward as well.
This is Converge, a podcast from Convera. Come with us as we shape the future of finance.
If you are in international business, you're affected by FX movements. In fact, even minor changes on the currency markets can massively impact profitability. So it really pays to have a sense of where markets and FX trends are going. But what is the best way of researching this? Well, one thing the industry relies on is Convera's annual report. Convera is the world's largest non-bank payment provider. And lo and behold, we're just 2 weeks away from the release of their new report called Are You Ready for 2025? So here to give us a deep dive into macro trends and currency movements for next year, we have two of the leading minds from Convera. So welcome to the show, Boris Kovacevic. Boris is the global macro strategist for Convera, and his colleague, George Vessey, lead FX thinker. Boris, George, great to have you with us.
Hi, Charles.
Thanks, Charles.
Our pleasure.
Cool, you're coming through loud and clear. Now, guys, the report's called Are You Ready for 2025? Personally, I am not. Trying to research this, I was really struggling with the amount of political uncertainty. Market's very hard to read. So I was just taken as a lead into this by an article on Inc.com, survey of American small business owners, entitled, aptly, I think, Small Business Uncertainty Hits a Record High. Entrepreneurs are feeling upbeat, but more uncertain than ever before. Sums up my emotions. Boris, can you just give us an overview? It feels really hard to predict what's going to happen next year. What's your take?
Yeah, thanks, Charles. I mean, as you said, I think this article is a good introduction into our discussion today, into the next 30 minutes. It is most certainly the case that uncertainty is high. Just to give you a bit of a backstory on the article and who is publishing the NFIB Uncertainty Index. So the NFIB is the National Federation of Independent Businesses in the US, and it basically sees itself as the voice for small and medium-sized enterprises. And one of the services they provide is, of course, they publish one of the, I would say, let's say a dozen of the most important leading indicators for the US and for gauging where the US is headed. And one of these sub-indicators is, of course, the uncertainty index, right? And as you clearly mentioned and read, the uncertainty index for small and medium-sized businesses is at an all-time high. And it is, of course, quite unusual, right? It is partially explained by the seasonality effect going into election. So usually in election years, every 4 years, you get a spike in October and November, clearly indicating that investors and businesses are nervous about the upcoming new administration coming with a lot of uncertainty, new tax policies. This year, it's a bit different because this can explain partially the rise. But of course, given it's at an all-time high, you have to avert to other factors explaining the increase. And this year, for example, it's quite many, right? It's not just one or two factors explaining it. It's inflation. If you look at the survey, dive deeper into it, 25% of the survey participants said that inflation is the most pressing topic for them right now. The second one is finding good employees, so the labor market. And then, of course, as always, it's taxes and interest rates. And I think the important thing for us is all four mentioned in our report, Are You Ready for 2024? And I think they are really important topics, not only for the US, as you mentioned, but I think also for our clients in Europe. But if we, for example, bring George into the discussion, I think also for the UK, right?
Yeah, exactly, Boris. I think you summed it up nicely. But in the UK in particular as well, we've seen that consumer and business confidence has fallen to the lowest level of this year. And that's despite the economic situation in the UK being relatively more robust than what we were expecting. We've had strong growth in the first half of the year. Retail sales have been up. The labour market has been resilient. The so-called misery index, which accounts for surmising the inflation rate and the unemployment rate, that's been improving for 12 months straight. Yet we've got this imbalance with between economic sentiment and economic data. So the fact that consumer confidence and business confidence levels are well below their historical average, despite the fact that the economy is actually doing quite well, suggests that there's something else that's really driving this pessimism. And I think, like you said, it's the uncertainty around these future risk events that we have looming: the UK budget at the end of the month, the US election, what this means for global trade and for economies going into next year. So I think, yeah, it's a similar situation. Uncertainty levels are high, and we've got a whole host of events that warrants that.
George and Boris, let's just frame what the objective here. I mean, I once had a deep conversation with Tim Harford, the FT's undercover economist, who's an advocate of scenario planning. He said, you know, forecasts, as we know, economic forecasts are like, you know, famously like chimps throwing darts at a dartboard, but you can produce scenarios. And I mean, is that what we're dealing with here? Because, you know, there's a scenario where Trump gets elected, pulls out of NATO, Putin's troops roll across Ukraine, maybe into Estonia, maybe into Latvia. That's one scenario. There's another scenario that Kamala Harris wins. There's static progress in Ukraine. So, I mean, is that what we're doing here? Maybe, Boris, can you just flesh out here what we're talking about? Because we're not trying to, you know, accurately forecast currency movements next year, because that isn't possible. What are we able to do accurately?
That is a perfect question. I think you already mentioned the US election, and it gives us the perfect example to talk about is binary prediction models and, of course, the scenario guides that we are producing. So for the US election, for example, the problem with elections overall, but especially the US one, is that markets don't like uncertainty. Markets are not operating on the basis of uncertainty, but certainty. And the problem here is that the presidential election is a binary by default or by nature, a binary outcome. You either get one president or the other. What you can do, though, is you can look beyond the US presidential election and look into the parliamentary election that is also coming up. And that, how we explain in our presidential guide, is probably more important than the presidential guide itself. So like in the UK, you have two chambers of parliament in the US called the Congress General, the lower house, the House of Representatives, and then the upper chamber, the Senate. And both are being voted on. And what you can produce is you can say, instead of who is going to win, Kamala Harris or Donald Trump, you can look at different scenario guides. You can look at, for example, Kamala Harris winning with a split Congress, meaning the Democrats don't take the full control of Parliament. This gives you vastly different implications for markets than, for example, what analysts call the Democratic sweep, meaning the Democrats take the White House and they take both chambers of the Parliament. And you can do the same thing for Trump. And what we're currently seeing is that in recent weeks, we have seen a significant increase of the probability of a red sweep, meaning that Donald Trump takes the White House, but also the Senate and the House of Representatives are taken by the Republicans. And I think this is something that is worrying markets. Not per se that Republicans will be in charge, but that one party will control pretty much the executive branch and the legislative branch. And this is, I think, what has been, you know, also somehow contributing to the uncertainty in markets, but also for businesses.
Yeah, I think just to jump in there as well, Charles, in terms of the currency impact, like you say, scenario-based approaches is what we really advocate, because you can't, inherently, you know, it's inaccurate to try and forecast exactly where a currency is going to end up. And with this situation that we've got with the US election, how we've seen markets react to a Trump victory is that it will be positive for the US dollar. And we do agree that that would be the case in the short term, but over the longer term, there's a clear historical bias towards the dollar actually appreciating during a Democrat presidential cycle compared to a Republican. So it's not just a clear-cut answer of the US dollar is going to strengthen under Trump and weaken under Harris, but you've got to look at the longer-term implications based on the policies that are being put forward as well. So the implications of Trump coming into power would be potentially, or we think, more inflationary, which is one of the reasons for the dollar appreciating due to the Federal Reserve potentially not being able to cut interest rates as much as what markets are expecting. But with the tariffs that are being or potentially being imposed on numerous countries, then of course that is inflationary, but it could also drive countries away from using the US dollar as well. So over the longer term, this might have a negative implication for the dollar. It's one of the reasons why perhaps over the longer term, the Republicans could be actually a weaker catalyst for the dollar. So there's so many scenarios to consider, especially in the currency market space as well.
I'll just squeeze in a question about fracking, because I'm of the opinion the Americans have got a sort of trump card when it comes to manufacturing because their energy costs are so low, because they're prepared to frack. In the UK, we've shot ourselves in the foot. We're headed for net zero very fast. As a result, our energy costs, I think industrial electrical costs are 5 times now in the UK compared to what they are in the US. Trump, one assumes, will just carry on fracking. It's what his backers want. Is there a danger that a Harris presidency could become more European in terms of its environmental policy and therefore hampering the US economy?
Yeah, maybe if I take it, George, and then you can follow up. I think that is you're kind of front-loading our questions on the US, Charles. I love it. But I think that is certainly how Europeans perceive it. I think Trump is one of the dangers of the European outlook going into next year in forecasting GDP growth for Europe and other parts of the world, like China, for example, or Mexico, that are heavily impacted by a Trump presidency. You wouldn't really get this kind of angst or worry over a Kamala presidency. In particular, I think this is a nuanced but important point. The probability of the Democrats winning both the White House and the Senate are basically none, right? So you either have Kamala winning the presidency, and then you have a split Congress between the Republicans and Democrats, which would limit the amount of policy making the president can actually do, because the president in the US has, of course, limited power, and most of it has to be signed by Congress. So I think this is the best case for scenario, and of course Europe, because it would mean that while Kamala would set the tone on foreign affairs, for example, she wouldn't be as hawkish on China. She wouldn't be as hawkish on Europe, and this is a good sign for markets. It would come, in my opinion, in the short term, a bit to the detriment of the US. But you can also argue the different case that her more relaxed laissez-faire policy on immigration would be beneficial for the neutral growth rate for the United States in terms of how much immigrants would come in. And you can talk about the social implications for that. But from an economic perspective, it's quite clear that it would be beneficial for the labor market and therefore the US economy. So as George said, it's really nuanced because there's a split in terms of how it would impact the Kamala and Trump debate, how they would impact the US economy and the world and FX market in the short term. But then it would be different in the long and in the medium term. So that's what's complicating the picture for us.
And just before we spin the globe, I'd like to ask you the worst case scenario. I mean, if Trump loses, he's already said, he may not accept the result. I mean, do you notice anyone seriously considering the possibility of not quite a civil war, but civil disturbances, extended political problems marching on the Capitol if Trump loses?
I mean, yeah, I can probably start with that as well. I'm not aware that any major investment bank or fintech is thinking about modeling that, because it's just unpredictable. As you mentioned, these are kind of the black swans that investors have to be prepared of. But in the short term, usually what you see, no matter who wins, given that political uncertainty and volatility do spike just immediately before the election, because as I said, markets don't like uncertainty. And uncertainty is to a certain extent gone after the election, because no matter who wins, you at least have a clear winner. Now, if we get a scenario that you describe in which the loser doesn't accept his loss, in this case, Trump, that would be a different story. And it would move into a category that is, I would say, a bit more warlike in terms of modeling. It wouldn't be just a normal case where you extrapolate the trends you have had into the future. It would be really something that you would use warlike models and black swan models for that as well.
Yeah, maybe we could just go ahead.
I'll just jump in there as well and say it's not something we consider in terms of a worst case scenario. I think in terms of the biggest risk to volatility on financial markets, which is what we are concerned about, would be a red sweep. So Trump winning and Republicans gaining control of Congress. I think that's going to have the most damage to the financial markets, or cause the most volatility and disruption to financial markets. So Boris mentioned the black swan event of the particular scenario that you mentioned, Charles. But I think we could probably put the Trump, the red sweep, as a grey rhino event, which is another risk event which we are aware of. This is visible. and we know it will happen, but for some reason, you're not taking the steps to kind of mitigate the risks of that happening at this stage until it's too late. So I think for us, in terms of our scenario planning, a red sweep would bring with it the most volatility to markets.
Just to spin the globe, and the theme of today's discussion really is uncertainty, but Eurozone and the UK suddenly feel quite stable, don't they? I mean, George, the UK has a Labour government. There was an investment summit this week, and Prime Minister Keir Starmer talked about his commitment to growth and unveiled a load of, well, did he unveil them or not? But many billions worth of investment. Inflation is low. There's no obvious disruption other than maybe the odd tax hike coming up. And maybe the same could be said of the Eurozone. There's no Gilets jaunes in Paris. Civil disturbances in Italy, non-existent. So, is the Eurozone predictable, George?
I'll stick with the UK for now. Maybe I'll hand over to Boris for the Eurozone. I mean, the UK economy, as I mentioned earlier, has been relatively robust compared to what people were expecting. Even over last year, there was a prolonged recession forecast by many economists, and we only saw the recession at the back end of last year. And then the first half of this year has been strong, and it has moderated somewhat. GDP growth returned in August, and I think it's the risk with this is that, as we've seen in financial markets, they aren't pricing as many Bank of England rate cuts over the course of the next 12 months. And as a result of that, we have seen the pound appreciating, which sort of reflects this fact that they've got higher yields in the UK, and that's boosted the pound, but as has the economic outperformance that we've seen of the UK relative to its European peers, to be honest. I mean, you say that Europe seems relatively or somewhat stable, but I would argue that it's probably not the case. We have seen some data come out today that's showing some signs of improvement, but actually a lot of European countries are in a worse state than what we see in the UK. The US is in a league of its own, but the UK economy has surprised more positively, I think, than other European economies, and that probably it tells you a lot to see that the sterling to euro exchange rate is at a 2-year high at the moment at 120. So that does reflect that kind of demand or optimism towards the UK currency over the euro. Boris, I don't know if you want to have your 2 cents in Europe. I know that you're out there in Vienna.
Yeah, for sure. I think it's, as you mentioned, the UK is kind of in a grey middle spot between the US and the European continent. I would preface that the last year and certainly this year has really been about US exceptionalism. The US outperforming other peers in terms of its economic growth. And I think it's a fair point, Charles, that we haven't really seen too much turmoil on the European continent as of this and the last year. But I wouldn't take the lack of turmoil as a sign of strength here, because we really lack some kind of dynamic macro environment in Europe. If you look at, for example, Germany, it's really going through structural change that we haven't really seen after the unification in the 1990s, right? Uncertainty is also really high. Competitive advantage is gone for Germany, given, as you mentioned already, high energy prices. Also, the lack of workers is really something that is starting to bite in the industrial space, which is down. If you look at the drawdown since 2021, industrial production is 25% below trend in Germany. So it's really, if you read the news in Germany, and especially in Austria, we can clearly see a sense of despair in sort of, because China is going its own way with its industrial policies. The US is going its way under Biden with pushing for more regionalism, which is not really the case under this unified Western Front, as we have seen over the last couple of decades. So this is what I think what's important to stress as well. This is not idiosyncratic uncertainty just tied to the US election. We have, for the first time, I would even say in 2 or 3 decades, different countries at the same time going through structural change. And this is why I've seen a question pop up about trade. I think trade is the frontier where this is going to play out, right? Because, of course, domestic policy in the US tied to the US election is important. But what is important for your UK listeners, for European listeners, is not really, in particular, domestic policy and the tax rate in the US. It will be about the sentiment towards Europe and China from the US perspective. So are they going to give us tariffs of 10%? This would really be crucial and detrimental for European growth in China, because Trump has said that he wants to implement a 60% tariff on Chinese goods. And there are models out there saying that if China retaliates, this would basically come to a still stand of Chinese US growth. These are two of the largest economies in the world, making up 40% of world GDP. If they stop trading, you'll definitely see an increase of, what some have called this slow globalization, meaning you will have some globalization, but it's really starting to slow down from the levels we're used to since, for example, China joined the WTO in 2001.
And I think Germany would be highly vulnerable to that, right? I mean, compared to the UK, Germany's reliance on China as a trading partner, it would feel those indirect effects of those tariffs that the US are threatening to impose on China. But compared to the UK, I don't think it would still take a hit from that, but not as much as say, Germany would.
Absolutely
We've
right.
got we have two questions from the audience, which I think should frame just the final 10 minutes here. Darren Morton, which currencies do you expect to strengthen or weaken in the coming year? No sniffing around the bush there. It just wants to know. I mean, you guys deal with scenarios, but can you just give us a blunt, as blunt a forecast as is possible? Boris, Euro, from what you've said, structural weaknesses in Germany, unresolved market reforms, multiple difficulties. Okay, there's no obvious, immediate crisis, but these ongoing problems, even the European Commission has put out reports saying growth is just anemic across the Eurozone. Can we safely say that the euro currency is going to continue to struggle in 2025?
Well, I'll start off the discussion and again, George can come in. But it's really difficult. It's more difficult than you would expect on the surface level, because one could argue that most of these uncertainty factors have been lingering for at least 1.5, 2 years. So most of them have already been priced in. The euro is trading well below its 5, 10, 15-year mean. And again, as I said, most of it has been priced in. What you have to look at from this current perspective, from the current status quo, which economy is likely to outperform the expectation. And in this case, I think we would argue that the euro has some potential to appreciate slightly, given that, as I said, the news flow for Europe has been weak, continuing to be weak for many months, and most of it is priced in. The US has been outperforming ever since the pandemic hit the world economy. And since then, there's more room for the US to downshift into a lower gear. Europe is already treading waters for quite some time. And if we get at least a slight uptick in 2025, this would at least dampen the downward pressure for the euro. So I think our overall base case for Euro USD is slightly up, but I wouldn't be surprised if we go down if, for example, Trump gets elected. So this is where our scenario guide comes in, right, George?
Yeah, exactly. I think, again, unfortunately, it does depend significantly on the US election outcome. But all else being equal, if we don't get a shock result that brings forward some of the tail risks that we have in our US election guide, for example, with a red sweep, as I mentioned earlier, then yes, I think cyclically speaking, the euro should strengthen against the US dollar going into next year, but it is dependent on many factors. And in terms of the pound, for example, growth and yield differentials relative to other nations does put it in quite a strong position. We've seen it break above 130, which is a psychological level. It reached 134, which was a 2-year high just recently, but it has pulled back. But the pound's an interesting one because it's highly sensitive to global risk appetite as well. So the tensions in the Middle East that are boiling over, that's had a negative impact on the pound, rising or the volatility in oil prices. That often has a correlation with the pound's movements as well. But again, if you just look at the outlook for next year and the outlook for the UK economy, it does point towards the pound potentially benefiting from improved growth outlook from the UK perspective, just because it's narrowing that gap that's been substantial between the US and other economies. So we're not saying that the UK is going to fire on all cylinders, but the difference between US economic exceptionalism and other countries is going to narrow, and that should favour pro-cyclical currencies, which does include the pound. So I think the future does look rosier for the pound. Whether or not we go above that 135 mark onto 140 is going to be dependent on the monetary policy outlook as well, whether or not the Bank of England cuts interest rates as much as what the Fed does. But to your question, Charles, around and answering Darren's question, around what the currencies might outperform strengthen next year, I think all eyes are on the Japanese yen as well, because Japanese yen has come under significant selling pressure over the last few years. One of the main reasons for that is that Japan has kept its interest rates so low, whereas obviously, as we know, other central banks have been hiking interest rates to multi-decade highs. So that's created this yield differential that doesn't favour the Japanese yen. And therefore, because we're now turning into this easing cycle, central banks are starting to cut interest rates, and the Bank of Japan has actually hiked a couple of times this year. That differential between interest rates should favour the Japanese yen going into next year. And again, because it's a traditional safe haven as well, if we do see a rise in geopolitical tensions, then the Japanese yen tends to benefit in that situation too. But I don't know, Boris, what are your thoughts on the Japanese yen? Because it is a particular currency of interest.
Yeah, most certainly. I think it's the third largest currency out there in terms of trading volume. So it is important, of course. I think one point I would mention is, as you said, the divergence in terms of not only economic growth, but also FX movements. We have seen usually that the last couple of years have really been quite a contrasting theme of divergence between countries and between currencies. So as you mentioned, we're currently in an easing cycle in both the United Kingdom, in Europe, in the US, where central banks are taking advantage of inflation falling, and they're trying to ease the pressure on the consumer by lowering interest rate. You can't really see the same in Japan, as George mentioned. So there is a bit of a divergence there. You have countries like China where they never started increasing interest rates. They never had this blunt force of higher interest rates in China because they have been completely desynchronized from anything that we have experienced in the West. They didn't have inflation, they didn't have high interest rates because they are currently stuck in what appears to be a deflationary cycle, right?
Okay. We just have, since we only got 5 minutes to go, this is almost an impossible question to answer, but from Sarah Connor, I think this is kind of perceptive, but what trade risks do you foresee in 2025? How will they disrupt the current trend for easing inflationary pressure? And I'd like just to refine that question because it's very broad. What are the potential shocks to the global economy that we ought to be just keeping a wary eye out for? I've got them in mind, Taiwan, China doing military exercise around Taiwan. There's a theory that the Chinese president has a timeline for reclaiming, recapturing, use your own word, the island of Taiwan. That's one, but it's a complicated world out there. So, Boris, any particular areas you think people should be keeping an eye on?
Yes, so the first one mentioned is already the Trump trade. So if Trump gets elected, I think he'll make promise of the increase of tariffs by 10%. I think his proposal to increase tariffs on China by 60% are just not feasible, given that it would raise inflation and it would undermine the US's status in the world economy. But I think we have to be prepared for Trump winning and promoting this term of regionalism, where every region is starting to work on its own industrial policy. So North America and maybe Central America, then you would have the European trading bloc, and then you would have the Asian trading bloc. I think this is a viable possible scenario that we have to keep in mind. The second one that you mentioned is already Taiwan. I think there are a couple of scenario guides talking about this vaguely in terms of the next 5 to 10 years. But this is just in a different dimension, I would say, in terms of its impact on markets. If this really happens, it would depend on the West's direction and its reaction to China attacking Taiwan. I think that's the main point. If the US makes promise of defending Taiwan as they verbally, indirectly did, then I think we would have the first conflict of the two largest economies in the world since the Cold War in the 1990s that ended, of course. If they don't start supporting Taiwan, then that would open up the Pandora box of saying what can happen in a world that isn't protected by US militarism. So it's a really complicated topic, but more so for political scientists than economists, because it's just too vague at this stage to really put into economic models.
It's fascinating. And just to end, really, we've got 2 minutes to go. I'd just like to know how your clients are reacting to all this uncertainty. Are you able to gauge the market sentiment by looking at the strategies your clients use? Do people do more long-term hedging if there's greater political uncertainty? Boris, what do people do?
George, you want to take this one?
Yeah, often companies with global operations, they lack the resources to run the kind of risk analysis that we do, and will have access to forward-looking currency market data and forecasts. So For the customers that we speak to, I think they really benefit from the kind of analysis that we're providing here. And for example, this Are You Ready for 2025 market outlook and our forecasts really underline the commitment to supporting our customers and the industry as a whole, because having access to this kind of insight does allow them to sort of identify any risks or opportunities that are out there, and prepare for the worst, not just hope for the best. And we are seeing some more long-term hedging strategies put into place because of the plethora of risk events that we have coming up. But as a whole, from our team's point of view, you know, we produce this research, this insight to allow financial decisions makers to make those more informed international trade and payment decisions.
Yeah, Boris, same with your clients?
Yeah, pretty much. I think even if you go across the spectrum to just looking at investment flows, you have clearly seen a trend to more hedging being taking place, not only in FX markets, but also equity markets. And people have taken advantage of these new advancements in technology, be it in, of course, FX hedging with, more multidimensional and more complicated products, but also, as I said, in equity hedging, in oil hedging, for example. If you just look at the oil market, oil volatility is at its highest since early 2022. So, of course, investors are not blind to all these risks. And as George mentioned, it is more difficult for small and medium-sized businesses to navigate through this macro environment. But there's certainly, hopefully, our guides help them navigate through them. And as I said, there are a lot of options on the financial market space to, hedge your bets in terms of the political and macro uncertainty.
Okay. Well, that's a thorough overview. Now, we started with the theme, it was uncertain, it was unpredictable, but I think you've really unearthed some of the nuances and threads that allow, hopefully, our viewers to make sense of what's going on in the global markets. If you want to download the report, it'll be available in a couple of weeks from Convera's website. And if some of you are going to Money 2020 in a fortnight's time in Las Vegas, Boris will be speaking on my diary, on the 29th of October. Mm-hmm. Boris will be talking about the US election. So, check out the schedule and you can head along and hear Boris speak and hopefully say hello to him afterwards. So from myself, from Boris, from George, and from everyone here at FinTech Talk, thank you very much.